with spreads and the yield curve, narrowing quite a bit. Please put the lights on again, and we'll take it from there. So, I was giving a speech in New York not long ago at the Marriott, and there was construction going on top of me, and the construction kept on getting louder, and I said, they're not going to beat us on this. I became louder, so eventually it sort of worked out. So I'm sure that we'll get the light situation on a steady pattern. Jordan, you want to come up?
Great. Okay, thank you very much, Maria. It's always a pleasure to be here. I noticed we came in, it's nice that the dinner followed the reception, where I noticed there was an open bar, and then before dinner I noticed they came around and were serving wine, and I wondered, is that because the CFA Society in LA is really friendly, or do you guys think you need a lot of drinks before you hear a technical analyst speak at a CFA Society? And it's kind of like inviting ants to a picnic, but anyway, we'll go from there. Here's the concern. In New York, despite the best efforts of our government officials to heat up the airways by sending pictures over Craigslist, it's kind of cold right now. And the thing about it being cold is it's actually unseasonably cold. And in fact, the unseasonably cold actually follows the fact that 2010 was the second or the hottest time on record, competing with 2005. And then if you compare that with Australia, which is having biblical floods, the size of Germany and France underwater, compare that to the droughts in Russia, compare that to the floods in Pakistan, then you're certainly getting a lot of inappropriate weather. And what the market from a psychological perspective is doing is starting to price in upside surprises and downside surprises to the weather. Now the market implications for that are very clear. If you look at the softs and ags markets, you see sugar, corn, wheat, soybeans, etc. blowing to the top side. Now bear in mind, this weather has not triggered these moves, but it has catalyzed moves that had already gone on. Now in the commodity complex, take softs and ags and put it with base metals. Have you noticed copper, alloy, zinc, tin through the roof? So this becomes statement number one. Look at the commodity markets, base metals, softs and grains, ags to the top side. What are the implications of that? Now consider the second thing. What are the things that the markets are concerned about? Well, number one, it seems to me the markets are concerned about the housing situation in America. The markets seem to be concerned about municipalities, and the markets seem to be concerned about the European debt spread, which I'm sure Stephen will talk about. What is the tapestry that runs through all of those things? Interest rates, commodities to the top side. Is that fanny inflation? There we look at the break-even markets and tips. Interest rates are key. When you look at the markets from the concerns about the headwinds for the stock markets, again, interest rates are key. I'll make a bold statement. Then no matter what you do for a living, for the next 10 years, everybody in this room is an interest rate trader. The last 10 years we were commodity traders. The last couple of years we were equity traders. There's only one dominant trend per asset class, and going forward we think it's the interest rate market. And we'll talk more about that throughout the day, throughout the evening. But interest rates will be crucial, especially as long bonds and 10s come up to some pretty important level. Whether we're seeing the normalization of interest rates in Germany, that's important. Don't forget the front end of the UK and the German curve is up 100 beeps just over the last 5 to 6 months. That's important. What is the interest rate market trying to tell us? Are we rolling from a 30-year bull market in rates towards a longer-term bear market in interest rates? And remember, long bonds were once at 13 to 14%, and if you told anybody it was going to 3%, they would say you're crazy. Well, here we are at 3 and 4%. How high can we go? And that's going to be an important statement. As for the equity market, let me be blunt. We don't like the equity market right here. I don't like some of the action in the transportation average. I don't like some of the action in the emerging market equities, which I'm sure we'll talk a lot about tonight. But we are still bullish on the equity market. We're not stand at the top of the mountain and scream bullish, but look, at the end of the day, this stock market in America has been in a range for 10 years. It looks like we pushed to the upper end of the range. That's still 10 to 15%, maybe 20% from here, except for the small caps. If you look at the Russell 2000, we're only 2% away from making all-time highs, so that's important. But for now, we're neutral on equities, but overall, we still think the tone remains bullish for the equity market. But if we're right on the rates market going forward, then the implications are going to be very important for foreign exchange. What's the pain trade? Dollar yen to the top side, because if we're right on this, then the interest rate carry is related to dollar yen, and we're starting to see dollar yen spike up. As for the euro, we don't think it's going anywhere fast. Where have you made money in foreign exchange? You've made money on the cross rates. The best currency has been stocky. The best trade in foreign exchange space last year, Euro Oz. We're bullish on energy, which means in the FX market, what is the Aussie of 2011? What is the trade in foreign exchange that is going to be the kingmaker? And as far as we're concerned, and I'm biased because I'm from Canada, so you may hear that if I say Mum Water, you ask me a question on hockey, which I am happy to answer. I have made more money on hockey bets on the New York trading floor than I have made in anything else. But I diverge. we think Canadian dollar is the Aussie of this year. So we're bullish on energy. Dollar CAD is clean positions. It's been in a range for the last 12 months. We're starting to break to the downside, so we really like the Canadian dollar this year. Not so much against the dollar, but CAD Swiss is one of our favorites to the top side. Euro CAD, even Aussie CAD to the downside. So in summation, we like risk. We're looking to the top side of the market in terms of the stock market, probably by the summer. We like the commodity markets. We like the emerging markets, but we do think it's in a corrective mode. I think you could take a 5 to 10% haircut in the EM space, but at the end of the day, I do believe, and I'm happy to go on record because we've written about this, the next 5 to 10 years is all about the interest rate markets, and I think that's the view we really have to talk about tonight. And I'll hand it back to you, Maria.
Great. Thank you. Thank you very much. That was a nice, quick kind of run around the world, covering currencies, commodities, and everything that's sort of concerning us these days. I think that, since we took a little bit broader, why don't we have Luz come up now? Luz, as you know, joined DoubleTree when the company got started, 2009. I have a few friends that also work with Luz. I have known for many years from my days at Merrill. Actually, there's somebody else here from my days at Merrill, Dave Alpert over there. Luz has been involved in emerging markets. I think, when I started my business 20 years ago after Drexel, we started an emerging market fund. And I remember a company up in Boston whose name will remain unnamed right now because I don't know if somebody there from there here. But I remember that they had a hard time pricing bonds in emerging markets because they didn't know what a voidus was. And at that time, they didn't even have a voidus in the company, but they were doing the custody for us. So in the last 20 years, we've come a long way in actually settling bonds in emerging markets, not only physically, but also, technologically speaking. So we've come a long way, and this has been in emerging markets throughout her career. On the fixed income side, she was at TCW since 1994, where she served in a number of roles, but increasing responsibilities within the group, including credit, director of research, and corporate portfolio manager since December 1. I started my career as a credit analyst, and my kind of early learning was that all credits are bad until you get your money back, and that's certainly the case in emerging markets also. Without further ado, Luz, why don't you come up and share your thoughts about what's going on in emerging markets, what you see this year, and the best and the worst opportunities maybe.
Thank you, and thank you for joining us tonight. It's interesting that you talk about emerging market debt, and I first started working in that asset class back in the mid-90s. It wasn't unusual for people to talk about emerging market debt as the Wild West, and it's not surprising given that the bulk of the investable universe at that point in time was restructured debt. These were debts that countries within emerging markets had defaulted on. They were newly issued bonds denominated in U.S. dollars, and that's what we were trading at that point in time. And since that time to today, there has been a sea change in terms of not only the asset class, but really what is available today. And I think it really started back in the early 2000s when we started to see a change in the underlying credit fundamentals of most of the countries within our investable universe. And as we saw that change, we started to see a lot of these countries not only start growing at multiple rates of those of developed markets, but also start to decrease their debt loads. And what we have today is a set of countries that continues to grow at multiple rates of those of developed markets and has a debt stock that is significantly lower and a debt-to-GDP ratio that is less than half of what we're seeing now in not only the U.S., but also in Europe. As a result, it's not surprising to see that a lot of these emerging economies have moved up the credit curve. Again, back when we first started investing in emerging market debt, it was a single B, high yield type asset class. Currently, most of the credits within our investable universe are rated investment grade. And again, back then, mostly restructured debt, and now we have three sectors of the market. We have sovereign debt, which I like to think of it when putting it in terms that investors in the U.S. can understand. It's like the U.S. bond market. These are bonds that are issued by the sovereigns of these emerging economies that are traded in U.S. dollars. Then we have the corporate market, and the corporate market really encompasses what I like to think of as the U.S. investment grade and the U.S. high yield. The emerging market corporate sector, again, primarily an investment grade sector, that has seen a sea change in terms of not only the underlying credit fundamentals, but also the type of information you can get from a lot of these companies is, the change has been like night and day. And then the third part is the local currency product. And there we really have seen a big change, not only because a lot of these countries are supporting that local currency development, but also because there's been a lot of foreign interest participation. And so with that, when I look at it as a participant in this market, I look at the opportunity set, and it really is a very large opportunity set. The local currency market, I liken it to the international fixed income market, and so it's more, instead of trading euros or yen, we're trading reais and, rubles or yuan. And so to me, there's a lot of product, there's a lot of sectors to choose from, and our task is to find the sector that we think offers the greatest opportunity for return on a risk-adjusted basis. In the current environment, when you look at sovereign dollar-denominated debt, corporate dollar-denominated debt, and local currency, we think that all three sectors can profit from the fact that a lot of these countries will continue to make strides in terms of improving their underlying credit fundamentals. I think with the fact that these are countries that have very strong, and companies that have very strong credit fundamentals, and they have the potential to continue to improve, we think that these are credits that can continue to migrate up the credit curve. As a result, we think that there is room for spread compression. However, when we look at valuations, we think that the sovereigns really have played out their in terms of their spread compression. There has been a significant spread compression that we've seen